Hey everyone, welcome back. In today's episode, we're going to continue the conversation around financing and interest rates in commercial real estate. And in particular, we're going to cover the topic of variable versus fixed rates. Let's dive into it. So on the agenda, we're first going to cover what is a variable rate loan. Like, what does that really mean? What does that mean to you as a borrower? And we'll contrast that with a fixed rate loan. And I think really the best way to do this is to kind of just compare the two options, right? Like, what does a variable rate payment mean? What does a fixed rate payment mean? And what are the pros and cons to help you choose between the two? So let's start off with variable rates. So first, what does that even mean, right? And I think the implication of having a variable interest rate on the loan is that your payments change when the underlying interest rate changes. So let's take a look at a quick example and then we can kind of work backwards through this. Let's say you have an outstanding loan balance of $100,000. If that interest rate during that first year is 7%, then that would work out to, at least on an interest-only payment, $583 per month. Now, if we were to take a look at the historical 10-year treasury rate, which is a common benchmark or point of reference for interest rates, this is what it looks like over the last 5 years. And so here we are at some point during 2018, we see a dramatic decline through the pandemic, and then we see this gradual increase coming out of the pandemic. That's a lot of volatility for this interest rate. And so imagine what that really means for your payment, right? If you took out a loan at 7% and the payment changed to 9%, you could see a substantive change in your payment. So again, in this example, it increases from $583 to $750 a month. And so I think the real lesson here is that the payment will change when the interest rate changes. And so maybe that questions, why would the interest rate change? And this for me is then again kind of peeling back the onion a little bit further and saying, all right, great. The interest rate will change when the underlying index changes. So let's unpack that a little bit. Let's assume that you've got a total interest rate of 6%. That 6% could be a combination of an index and a margin. So up top on the margin, we have this negotiated spread or this negotiated profit margin, if you will, that is set by the lender, and it is fixed for the life of the loan typically. So we could come in and negotiate with the lender and we'll go back and forth. Maybe they start at 3.5 and I counter at 2.5 and we end up at 3.0. But the margin is then set and fixed within the loan documents. And it is the underlying index, the point of reference, that changes. So it may be chosen by the lender and even potentially negotiated between the lender and the borrower, but the lender doesn't pick what happens to that index from one day, month, quarter, year to the next. The market does. So if we were to take a look at this hypothetical example, let's say in November, the index is 3 and the margin is 3 for a total of 6%. But what if the Federal Reserve comes out and says, no, you know what, we're going to lower rates or we're going to raise rates, right? So in this example, it's lowering rates. So you'll notice that the margin stays the same. It's still the same 3%, but the underlying index changed from 3 to 2. And so now the global rate is 5. And we can take it one step further, right? What if the following month, now in January, the index falls even further to 1%? The global is now a 4% rate, the 3 margin plus the 1 index. So this then again kind of begs the question. So what are the different indices that are available for selection by a lender or negotiation between lender and borrower? There are a lot of choices, right? So term SOFR is a popular one these days, but it could be one of the US Treasuries. LIBOR has been phased out. It could be Journal Prime, the BSBY. There's a lot of different ones, but I think it's really important to keep in mind that these underlying indices change through time based on market factors. And that's that last bullet that I wanted to make sure that was clear. The lender themselves doesn't change the index. they don't say, oh, you know what, the index is 3 today and 2 tomorrow, or 3 today and 4 tomorrow. Instead, they rely on the market to tell them. So again, as an example, this is the underlying US 10-year Treasury. So the 10-year Treasury is the representative or indicative interest rate for the 10-year Treasury bond in the United States. And so this is what it looks like through all time. So going back to early 1960s. You'll notice there's quite a bit of volatility, right? This is what it looks like going back 10 years. So this is how the 10-year Treasury rate has trended over the last 10 years. And so again, a significant amount of volatility, right? So these things are cyclical. But having a variable rate means that you could either benefit from declines in underlying index, like happened here between 2018 and 2020, or you could be on the losing end, where your interest rate will increase, and so then your payment will increase, like is happening here between 2020 and 2023. So the real lesson here is that when we talk about variable interest rates, those interest rates are governed by indices, and those indices are really what's capturing everyone's attention to help them figure out what their payment is going to be. Now, let's take a look at what happens when we compare that to a fixed rate loan. This one I think is a lot more straightforward, right? The payments don't change because the underlying rate doesn't change. So if we come back to the same example, here we have November, the index is 3, the margin is 3. In December, it's the same 3 and 3. And in January, it's the same 3 and 3. So if we take a look at pros and cons, then I think we can begin to create almost like a little matrix that helps us describe where these different kinds of loan types are either good or bad based on different circumstances. So let's talk about interest rate risk, right? So the fixed rate loan typically doesn't have any interest rate risk because it's a fixed rate. And that means that the borrower doesn't benefit or suffer when rates change. On a variable rate loan, this is where the borrower could benefit or suffer when interest rates change. And I put a question mark here because some borrowers may want to, I'll say, gamble or hedge or to a certain degree speculate on what they think is going to happen to interest rates and try to manage that interest rate risk. So you may be a borrower who believes that interest rates are going to decline into the future. You may choose a variable rate loan. Now, if you want long-term predictability, that's oftentimes where the fixed rate loan wins out. So if you just want to set it and forget it and know that your monthly budget isn't going to change when you have to pay your lender, the fixed rate is obviously the way to go. Now, where I think we can have a solid amount of debate here is what about affordability? Now, typically, the variable rate loans tend to be a little less expensive on an all-in rate when compared to a fixed rate loan because the variable rate loan shifts interest rate volatility onto the borrower. And so in exchange for the lender not having to bear that risk, those rates can be a little bit lower. But generally speaking, while that may be the case, it isn't always the case. So today it is, but tomorrow it may not be. And then the last is, what about amortization, right? Like, how do you deal with the loan balance, either changing or not changing over time? And again, I put a bit of a question mark here because it's possible for you to almost create an instrument that gives you both. It's possible for you to have a fixed rate, fully amortizing loan. It's also possible for you to have a variable rate, partial amortization, or even full amortization, or constant amortization loan. I think there's a couple different kinds of amortizing structures, which we'll cover in another video, but it's possible for you to have both in certain circumstances. So I think the real lesson here is, I don't know if there's necessarily a good or bad loan or a good or bad difference between the two. It really is up to the borrower to decide what their strategy is and then pick the right option between them. So just to recap, variable rate loans, interest rates change so that payments change. The interest rate changes because of the underlying index. Fixed rate loans, payment remains consistent throughout the life of the loan. There are pros and cons between them, but I'd really venture to say that the pros or cons are defined by the strategy or perspective of that borrower. So if that borrower wants to take on responsibility for interest rate risk, maybe they'll choose a variable rate loan and gamble that rates will decline in their favor, or not. So we can explore this in a lot more detail in another video, but for now I just wanted to broach the subject about what a variable rate or a fixed rate loan could be when you begin to evaluate commercial real estate financing. So as always, thank you for taking the time. Hope you enjoyed this video. If you have any questions, please let me know. If not, I'll see you in the next one. Thanks.